So getting into interpreting 42 macro research from the perspective of our friends in the investment advisor community. As always, you guys can use our discretionary risk management overlay, aka Dr. Mo, to implement a customized version of KISS or as a market timing and position sizing guide for your own factor bets. And if you need help generating your own factor bets, just look at the key portfolio construction considerations down here at the bottom of the page. So, you guys know how this process works. The proper trade recommendations here are a function of the interplay between the top-down market regime and the volatility adjusted momentum signal for the particular exposure. We had some changes this week, mostly coming from the commodity space, which we've liked from a thematic standpoint. We had agricultural breakdown to a long half position by going transition to neutral VAMs. We had commodities, PBDC, as well as crude oil, USO, also break down to long half positions vis-a-vis bullish to neutral VAMs phase transitions in those instruments. We also had a similar dynamic happen in uranium. So the market is essentially saying we're at the top of the growth cycle. Both growth and inflation, nominal GDP are likely to slow over the medium term, and investors are starting to rotate out of the commodities asset class. I don't think this is the best strategy from a longer term perspective, given that we remain in a late cycle economic environment and late in the business cycle. You tend to have commodity producers, commodities generally speaking, tend to outperform most other equity factors, most asset classes late in the business cycle. So this is perhaps a temporary reprieve and a viable dip from a longer term perspective, sort of kind of on a 1 year plus type time horizon. So that just be aware of those changes. And then obviously anything we highlight in any given day is what's most recently changed since our last publication there. So just keeping it moving here. We use our volatility adjusted momentum signal to determine which exposures are most likely to perform as expected in the current regime. So again, as I mentioned, in terms of the proper trade logic, how that works again is the interplay between the top-down market regime and how the asset has historically performed in the regime, and with respect to how the assets have historically performed. So we've done a lot of back testing, as you know. All of our models are carefully back tested. We finally had some time to create some good output with respect to our VAMs and global macro risk matrix back tests. So I'll just kind of give you some quick highlights before we leave you with the broader data set here on slide 16. We'll go into our VAMs back test. So we understand. So what we did was we took we summed daily log price changes since the start of 1998. And segmented those out by regime, at least with respect to the volatility adjusted momentum signal back test. So with respect to S&P 500, 76% of the cumulative 162% return since then has come in a bullish VAMS condition. 8% has come in a neutral VAMS condition, and 16% has come in a bearish VAMS condition. With respect to Bitcoin, crypto, 98% of the cumulative performance since the advent of the asset class back in 2009 or 2010 came in a bullish VAMS condition when Bitcoin was in bullish VAMS. Only 5% of that came when it was neutral, and then minus 3% of that, i.e. We had a negative return when Bitcoin was in bearish VAMS. So this back test here shows you the efficacy of using our volatility adjusted momentum signal as a key determinant of your factor bets and of your general risk management and your portfolio tilts. It's obviously a very powerful tool in terms of understanding, taking advantage of momentum in asset classes. We obviously use our volatility adjusted momentum signal to drive. It's the main driver of our global macro risk matrix, the process we use to nowcast the market regime. And as we can see because of the efficacy of the efficacy of the volatility adjusted momentum signal itself, it actually does a tremendous job at helping investors stay on the right side of market risk through the lens of our market regime nowcasting process. So kind of identifying this, going back to the breakdown here. If you look at the cumulative performance of the S&P 500 in a risk on market regime, Goldilocks is 44%, reflation is 39%. That compares very favorably to only 8% and 9%, 8% and 8% or 9% respectively in the two risk off regimes. If you want to summarize some of that, i.e. risk on being Goldilocks or inflation, and risk off being inflation and deflation, 83% of the positive return we've had in the S&P 500 has come in a risk on market regime, again, of which we're using 42 volatility adjusted momentum signals across asset markets, different asset markets to determine what the market regime is. And only 17% of the S&P's return has come during a risk off market regime. You can see this on a Sharpe ratio basis as well, as the Sharpe ratios for the S&P 500 are significantly higher in risk on market regimes than they are in a risk off market regime. Same dynamic exists with Bitcoin, only to a more extreme degree. So if you look at the cumulative performance of Bitcoin by market regime, 62% in Goldilocks, 47% in reflation versus minus 7% 1% of the total return being in inflation and minus 2% of the total return being in deflation. If you want to break this apart from risk on, risk off perspective, Bitcoin, it's 109% of the total return we've seen in Bitcoin, cumulative performance we've seen in Bitcoin since the advent of the asset class has come in a risk on market regime versus only 9% is in a risk off market regime. So, we don't talk about the VAMP signal and the market regime for poops and giggles. The volatile adjusted momentum signal and the market regime aren't the dominant driver of our case portfolio construction process for poops and giggles. We say this stuff because it works. It's obviously incredibly powerful. This is more powerful than anything you heard about flows, dealer gamma flows, positioning, plumbing, all this other liquidity, all these other things that you guys are spending a tremendous amount of time on trying to figure out, which are important to figure out. And we certainly do a good job of helping you figure those things out. At the end of the day, the most powerful force in asset markets is momentum. And if you have powerful tools like our volatility adjusted momentum signal and our global macro risk matrix to track and identify inflections in momentum, then you're going to do a much better job of staying on the right side of market risk by, being long the things that are going up and out and or short of the things that are going down in price, much better than the average investor. You can see all this data summarized here across equity factors, equity sectors, equity factors, global equity factors, fixed income factors, and then global macro factors across currencies, commodities, et cetera. And so all those back tests, you can review that on your own time. But the key takeaway from this discussion was to remind you that there's a reason we lean on our quantitative risk management signals to guide our portfolio construction recommendations and our asset allocation recommendations, because these are our most powerful tools of helping you generate and make and save money in financial markets. And so we're quite proud of that. So we'll just definitely take some time and review these back tests whenever you get some time.